So, let's kick off. Actually start looking at some charts. Now, this is the easy stuff, and it's just a reminder for anybody who might have forgotten. Of course, experienced hands watching this will know fully what I'm talking about. That's a price chart. See it at the top. Let me show you the top bits. All of these, day in, day out, each bar representing a day. Of course, you know all of this. That's a single day. Open, high, low, close. That's the high. That's the open, that little horizontal line there. That's the close. And that's the low for the day. And that's the range in which the price moved at any given point. Now, that you might think is a lot of information, or you might think it's very little. Actually, it's a lot of information, and it's a lot of information which we can use to our benefit when we're trading and investing. That's the basics. That's the beginning. Let's look at how we go about using this lot of information specifically. Well, first of all, let me just get some glossary material out of the way and the terms I'm going to be using. First of all, I'm going to be talking about higher highs and higher lows. Well, that's a higher low. That's when the price makes a higher low. You can see why. That's a low, that's a higher low, and that's a higher low. We're talking about relative to the preceding day. So that's day 1, day 2, day 3. Higher low, higher low. That's a higher high, that's a higher high. That's a lower high, obviously. That's when we're talking about the downtrend, and that's the price there. And they're lower lows. I know it sounds awful, but it's something which we have to refer to because it's very important when we're deciding later on where to put our exits, where to put our entry levels, when we should stay in a stock, when we should exit, that we're familiar with such terms. Okay, why are we doing all of this? I mentioned previously what we're looking to do. We're looking to have high probability trades. We're looking to have good returns, low risk. Well, actually, what we're trying to do is, with any particular stock, is this. We're trying to get in here where all the O's are, and we're trying to get out here. We want to sell at the P's, and we want to buy at the O's. Of course we do. Well, that's stating the obvious, but I just thought I would state the obvious, because sometimes, God knows this of fund managers, what they'll do is they'll see a stock plummeting, they won't care. They'll just say, oh, I think I'll buy some more. And they've got no idea what the price chart looks like, and they don't seem to care. And little wonder that their performance is so poor and our pensions are all stuffed. And that's why we want to make very clear exactly why we're doing this and what we're looking at and what we're looking for. Okay, now you can see Grandpa over here is getting a bit confused. Don't worry, I'm not going to go through this at the moment. What I wanted to just show you is there's lots of different ways of depicting price charts. We're going to go into this. This is Japanese candlesticks a little bit later, but more importantly, for both our beginners and advanced users, we're going to go through it in terms of how I use it, and I think are quite clever ways of using it. Although Grandpa looks quite perplexed, and you might be at the moment, don't worry, we're going to return to these, but it's just to show you there's different ways of depicting prices than just the ones that I've showed you. The ones that I showed you previously are called candlesticks, Western candlesticks. These are Japanese candlesticks. Got absolutely nothing to do with wax. Okay, and to make you really confused, these are yet different ways of producing price charts. Kagi. We're not even going to touch these. I don't use them. I hardly know anybody who does. And if you do use them, it makes your eyes go like that. But again, it was just to show you there's 101 ways of depicting prices about stock. This is what we're eventually going to get up to. Now, at this point, you're probably feeling a little bit scared. I wouldn't be surprised. We will eventually get into this kind of knowledge, know-how, and understanding. What you can see at the top are price charts. What you see here are indicators. The MACD, one of my favorites, and I'll explain how we use it. What you see here is the stochastic. Again, another one of my favorites, and I'll explain how I use it. The momentum indicator, the relative strength. These red lines here are Bollinger Bands, and I'll go through all of that. Trust me, by the time we're through, you'll be able to read this in about 3 seconds flat and decide, do I want to focus on this or do I want to move to the next chart? What do I want to do? And, there's Grandpa again. He's got confused all over again. Okay, trading with the odds. What does it mean when we say we're trading with the odds? And what we're looking to do? Well, let me first of all, just to whet your appetite, show you one little trick that we as traders often use. Now, you've all come across trend lines. They're these lovely things, and they're dull and boring, and they're so basic, and you wouldn't expect me to go through basic material. They're just these things here, which lines which join up where prices have bounced off. So there you've got the price has gone up like this, and we've drawn this line over here to show an upward trend line. Fine, gee whiz. How does that actually help us trade with the odds? Well, it's not as many basic tutors would tell you, oh, draw a trend line. And that's what happens when you're recording live. Anyway, as I was saying, going forward, we've got the bounce of the prices off the trend line. And the basic tutors would tell you, well, what you do is you just buy when it bounces off the trend line. Well, that's not why I'm showing you this graph. What I'm showing you is what a professional trader does. What a professional trader does is think, well, yes, I might want to buy. That's one side of the equation. But why do I want to look at this? I want to look at this because it gives me the opportunity to put a narrow stop loss. This type of chart tells me that if I am wrong, then I'll know it pretty quickly. Because if I'm wrong, the price would go somewhere where it shouldn't go if I'm right. Now, I know that sounds really convoluted. That's because good trading can often be so. Let me explain. This is what we're looking at, and we're expecting the price to bounce off this trend line. Then one thing the price shouldn't do if we're bullish and we're correct is it shouldn't go down here. It shouldn't ever enter this point over here if we're right and we're bullish. Therefore, if the price does enter this point, we were wrong. Remember what I said in the earlier chapters, that if we're wrong, we want to get out, we need to think about how do we know we are wrong. Well, we would know we're wrong if the price went down here. If the price went down here, we know we're wrong. Therefore, we put a stop loss just beneath this trend line, just at the point where the price shouldn't go. That's why this pattern is important. Not because of trend lines, which are just basic, not because of our view on the stock. It's important because it gives us an idea of where we can put a very tight or narrow stop loss. In other words, we'll know we're wrong pretty quickly, and we won't have to waste a lot of money once we are. And we do find out that we're wrong. In other words, we don't have to wait until the stock drops all the way down here and lose a lot of money to find out, oh, we're wrong, I shouldn't have got in this. We can put it fairly close. That's why this is often a high probability trade. It might only work 7 times out of 10, but that's fine. It's still high probability because look at the kinds of upsides we're looking at. We're probably looking at something going from 900 pence to about 1,000 at least. That's 100 pence rise. Downside, worst case, we're probably looking at a downside of maybe, 30 pence, 40 pence. Well, that gives us a very good reward to risk ratio. That's what I mean by being a little bit clever, trading with the odds, and using things in the way we professional traders do. Here's another example. Downtrend line this time. We're expecting a breakout of the price. To be honest, this trend line here, this blue one, I could have drawn down here like this, going this way, with the price breaking out here. It doesn't really matter. Treat it like this. And the point is, we think all of a sudden the price is bullish, it's broken above this downtrend line, it's gone up here. Therefore, let's say we turn bullish. Well, that's neither here nor there. Whether we turn bullish will depend not just upon the breaking of a trend line, of course, but all the indicators we're going to look at, the news stories, whether the sector's doing well, all the other factors that I'm going to talk about later. The reason I want to show this to you now is because I want to show you this part here. We put the stop loss in at a point where the price should not go if our bullish views were correct. I'll say it again. Put the stop loss at a point the price should not go if our bullish views are correct. It allows us to put the stop loss at a relatively low level, and therefore our risk of loss is low, and the amount of money we lose is relatively low. Again, similar example, Granada Group. This is where we might be going short. Maybe you're a spread better. You think you want to make £10 for every penny Granada drops. You think it's going to drop 100 pence, so you want to make £10 for every one of those points, £1,000 profit. So you short the stock. In other words, you say to the spread betting company, here's the price at 1,000 pence. I want to sell Granada at 10 pence. This is when, in the good old days when Granada existed, of course. But I wanted to show you this example because it's a pretty nice pattern. 1,000 pence, £10 per point short. And what happens there is, as it drops, you make your money. But what were we talking about? Where do we put the stop loss? Well, we put the stop loss up here, don't we? And the reason is, if this is going to fall and we're short the stock, in other words, we've sold it, expecting the price to fall, what should the price not do? Well, the price shouldn't go back up here. It shouldn't be moving back up. If it shouldn't be moving back up, then we want the stop loss to be about here. If it did move back up, what's our loss? Our loss is probably going to be 20, 30 pence. What's our gain when we expect this to drop? By the way, for those of you who are familiar, this is a head and shoulders pattern. And I'll mention some books and things where you can find out more about these things. But it's a Head and Shoulders, which is a bearish pattern. And that's the support line, this line here. And what we're expecting is it's going to fall below it. Now, there's another way you could have done this trade. When the price was around here, you could have said, what I'm going to do is I'm going to wait. I don't know whether it's going to go up or down. If the price drops, I'm going to sell it short with a stop here. If the price bounces up, I'm going to go long. I'm going to buy the stock with a stop down here. You would have reversed the position. Why? Well, because you don't care whether the stock goes up or down. You just want to make a trade. And you want to make sure your stop loss is quite tight, based upon where the price should not go, if your view is correct. I hope that's all clear. If it isn't, do go through this section again. I know it's quite complicated. That's why we've kept these in 10-minute batches. That's all for this bit. Do review and make sure you understand all parts of it.